Best ever listeners, welcome to the Best Ever CRE podcast. I'm your host, Joe Cornwell, and today I am joined by Troy Zimmerman. Troy is a general partner in the Missional Capital Group. They're based in Charleston, South Carolina, and invested in all kinds of real estate assets that we are going to talk about today. First time on the show. Troy, welcome. How are you today?
I'm good. Thank you, Joe. Appreciate you having me on and allowing me to share my story.
Yeah, well, we appreciate you being here. So again, first time on the show. So why don't we start with a little bit about your background, where you're from, and how'd you get into real estate?
Sure. I'll start with the important stuff first. I'm a husband to an amazing wife and have 4 kids, and they always think it's really cool when dad's on a podcast. So, hey guys, love you. I've been a financial advisor for 20 plus years and have actually been, had my hands in real estate for over 20 years as well. Started in real estate really on the single tenant triple net side.
Okay.
Managing different properties. We had some family legacy assets, CVS's, Walgreens, Goodyear's, things like that.
This was things you inherited in the family?
I haven't inherited them, but we still manage them. Yeah, they're still part of the family estate. So started doing that. That was my first introduction to real estate. And, it was great getting to work with national tenants, seeing how real estate can be a lifeline in up and down markets, understanding, how cap rates affect the value of your properties. And, that was where I started. 2010, started buying a bunch of single family residential after the great financial crisis. So moved into that space.
What market were you in then?
Chicago. Yeah, near Chicago. So 2010, my brother-in-law and I, we put a little bit of cash together and we bought about a dozen single family properties in the Chicagoland area. And just recently sold those 2022, 2023.
Okay.
Got into multifamily in 2018. And really that's where I've been focusing for the last 8 years is multifamily and multi-tenant retail. Okay.
Interesting. So I guess general thoughts. It sounds like the first, asset class you were in was certainly kind of forced on you, meaning you inherited, then ultimately managed. When I say inherited, you inherited the management of these assets. Right. So didn't sound like that was necessarily something you sought out to do, but it happened. And I think that's a common thing in real estate where a lot of first-time landlords are accidental, right? Where maybe you keep a house that you thought you were going to sell and the market didn't make sense, or you inherit a home or whatever it may be. There's a lot of accidental landlords. So what was the evolution of your mindset and philosophy and how you went from triple net to single family to multifamily into sounds like mixed use and commercial? So what was the thought process along the line?
Yeah, so you're right. The single tenant triple net properties were kind of a way for me to be involved in my family's business. So you're right. It was not pushed on me, but it was certainly something that was not mine, but was fortunate to steward that for my family. In 2010, I think we saw the kind of the destruction of the great financial crisis. And that's where I said, okay, I'm going to start my own real estate journey. And that's where we started buying single family residential properties. Where we've moved to recently where I've focused is more on creating value in different properties where I feel I can control the value creation. If you look back at single family retail or single family properties, you're really restricted by the comp, right? So where I'm focused now is focusing on properties that I can control the NOI a little bit more, focusing on net operating income, bringing expenses down, systematically increasing rents in a fair and ethical way for tenants. But that gives you a lot of flexibility in your exit, right?
Yeah, absolutely. Yeah, instead of having to try to sell 12 properties individually, you can sell or refinance one asset.
Yeah, but even more than that, for me, I'll give you a good example. Like single tenant retail is primarily driven by cap rates, right? So the lease is fairly set. You're not gonna negotiate with Walgreens and say, hey, you know what? Inflation went up this year. I'm going to renegotiate your lease.
Yeah.
Those leases are set for 20 years, very small escalation. So really your primary driver is that cap rate. Where are cap rates at when you go to sell? I saw a buyer purchase a Walgreens in Tempe, Arizona, bought the bottom of the market, bought it at a 4.5 cap, bought it for $11 million. 2 years later, cap rates are at $6.5 million. On paper, his value has dropped over $3 million just by buying at the wrong time. No way to control the NOI.
Yeah.
So that's where I'm focusing on. I think you have a lot more control in multifamily and multi-tenant retail when you're focused on NOI.
Yeah, that makes total sense. And that was, and I don't own anything triple net. I have friends that do. I've never really understood the investing strategy behind it because, as you said, it's great. It's a safe kind of hedge, I guess, against inflation in some way. But yeah, I mean, they're very. It almost feels like you have to time the market in those investments because if cap rates compress to a certain point, the odds are you're never going to get a better exit than that. And to me, I've just never fundamentally understood the mindset behind it outside of the obvious passivity of it, which is meaning probably the main upside in those for most people if they really want a relatively passive investor that they can actively own and manage because if the single tenant is responsible for everything inside and out, then you have effectively no management of the asset. But yeah, I'm just curious what your thoughts were. Sounds like you learned from dealing with those and decided not to expand into that market.
Yeah, we were fortunate, and when we've exited, cap rates worked in our favor. But I've seen the other side, and yeah, it's not something that I was interested in long term. Being locked into a long term lease with very minimal rent escalation. So, also didn't love what was happening in the pharmacy space. Yeah, so for us to get out of those Walgreens, CVS's, they're closing a lot of properties across the country. A lot of just dark properties sitting out there, and some of them, you're still getting rent, but obviously when that lease runs out, you're sitting with a huge vacant property with not a lot of opportunity to retrofit that.
Yeah, absolutely. Okay, so you got into the multifamily, and what has your primary business model been since, I think you said 2018 till now? What have you been focused on?
Yeah, so we started buying smaller multifamily because it was just my partner and I. So we bought a 20 unit in 2018. Most of these are in Northwest Alabama. And really, it wasn't until recently, being a financial planner, I'm not sure if you're aware of this, but there are a lot of regulations on what you can do outside of your broker dealer's kind of reach. So while we were buying up some smaller multifamily, the dream was always to, hey, let's bring people in, let's bring in investors, and let's try to scale and grow and buy larger properties along the way. So it was a couple of years ago where I finally made a big change in my compliance structure, had to create my own RIA, registered investment advisory firm. And that allowed me to go out and do a Reg D fund and raise capital for real estate deals. So we've bought 2 properties in the last year in Northwest Alabama, bought a 55 unit complex and a 71 unit complex. A, B class properties, really solid properties. So that's kind of where we're moving to at this point. So not a lot of value add like you asked, but just turnkey properties. We're bringing in a lot of cash, low leverage, fixed income.
So it sounds like the type of investor that you are partnering with on these deals are people who are looking for a very risk adjusted return. You're buying stabilized assets. All you have to effectively do is continue or maybe improve operations, and they're going to cash flow day one, and that's what they're looking for, the stability of that type of asset. Is that correct assumption?
Yeah, that's exactly right. And that's kind of been my philosophy on real estate as well. If I want to take more risk, I can go to the stock market. I can go buy Bitcoin. I can, things that I I like. But when I look at my real estate, that is the bedrock. So I don't want to take risk there. I want consistent cash flow. I want to improve operations long term and deliver a great experience for our investors.
Yeah, and obviously, I know this is deal by deal, and you don't have to give specific. But is there a range of returns that you are targeting on a deal like that that's relatively stabilized and effectively you're going to take over operations of the deal?
Yeah, both the deals that we purchased, initial cash on cash is around 6%.
Okay.
We both of these deals, we felt the average rent over the community was low. So we've been really successful in already ratcheting up that rent. We are very careful because we want to treat our tenants with respect as well. But we've been successful in getting those up closer to market rent. So, we've got IRR projections. I hesitate to throw out an IRR just because it's so easily, manipulated based on time in the deal. But no, I would say within 3 to 5 years, these are cash flowing, cash on cash, somewhere 8, 9, 10%.
Yeah.
Increasing the NOI, and we're not trying to get out quickly. So at the end of 7 to 10 years, we're projecting mid-teens returns on those type of investments.
Yeah, no, that's great. And that makes a lot of sense. And that's what's so interesting to me in contrast to what the types of deals I'm trying to do right now today. They are inherently more risk. I'm looking at some major redevelopments. I'm looking at some ground up construction, and some of these are like keeping one piece, building new on some of it. So it's like a mix. And a lot of what I've done the last couple of years is mixed use as well. So it'll be first floor retail, maybe second, third, either residential or neighborhood office or something like that.
I listened to your interview on Rod Khleif. It was interesting.
Oh, cool.
It was you did a great job. I was kind of interested to hear what you're doing, and
but it's and it's we're literally right at the precipice now, and this will be my first actual syndication. So I've raised capital with some joint venture structures in the past, but this will be my first actual syndicated structure where we're raising LP money with my business partner. But it's so we're it's very timely in the sense of I'm looking at the investors that we are going to talk to.
Yep.
I'm looking at what is their mindset, and then I'm like, okay, who is my ideal investor in this type of deal, these types of deals that we're doing? It's like, you have to have somebody who's okay with no cash flow day one, right? Obviously, inherently, if you're buying a shell. 2, they're okay with, if things don't go well, they're okay with a low floor, right? Because obviously, if deals don't go well, the floor is going to be really low. But the upside is obviously can be significantly higher, right? But you have to have somebody whose mindset is in that that ballpark, right? Of that type of philosophy that these deals are inherently risky, as opposed to the ones that you're talking about, right? To me, what you're doing is other than maybe triple net, they're as low risk or close to as low risk as you can do within real estate.
We're trying to be that solution for different investors. And it's similar to my profession, right? When I bring on a new client, I have to assess their risk tolerance and build a portfolio around their risk tolerance. So for us at Missional Capital Group, we've got a lot, some of my clients are in these deals. We've got a lot of successful business owners that just want a place to get a better return, to get the tax benefits of real estate. Bonds, they're not excited about bonds right now. Bonds are kind of dead money in a period of hyperinflation, within the dollar. Our risk, our ideal investor probably has a lower risk tolerance than yours. But that's the great thing about real estate, right? There's so many different ways to create value and to make money in real estate. So I'm excited to see what you're doing.
Well, I think I appreciate you checking out that podcast, and we did another breakdown on that deal with my business partner. He was on the show a couple months ago, and we really kind of dove into the numbers we were underwriting at that point. And I've done some of the things you're talking about as far as looking at a deal where it's like, this is an operational play, right? There's some upside in operations here, but maybe it's relatively fully occupied. Maybe there's some very light unit turns, typically like kind of just I guess I define them a little differently, where it's like maybe someone's lived there for 10 or 15 years. So of course you have to do a turnover, but it's not, you're not going in and completely redesigning this type of asset. You're not really going from like a D to C class or from a C to a B class type of asset or even type of tenant. And those are, if they cash flow day one, right, they're inherently less risky. But again, the range of outcomes is probably more compressed. Um, I'm just making up numbers, but like you're looking at like a 5 to 15 or 5 to 20% return, and obviously, if you're willing to take a bigger risk, then it obviously could be higher outcome. You mentioned some of the multi-tenant retail. Tell me a little bit about that.
Yeah. So kind of going back to where our family was in owning some of these single tenant properties, and just not loving that business model.
Mm-hmm.
Like we talked about, the leases are set, especially when I saw, the government print, what is it? 40% of the dollars that have ever been created were created in the last 4 years.
Yeah.
And I'm locked into these long-term leases with no
Yeah.
rent escalation.
Yeah.
So cap rates compressed. It gave us a really good exit opportunity on especially the pharmacy stores. I didn't love that business model anyway. You've got Amazon, every grocery store now has a pharmacy. So
Right.
I said, this is a good opportunity for us to get out of these and to move into some multi-tenant retail. So we bought a couple different facilities. One in Tucson, Arizona. It's got 15 different tenants, some national, some not. Your typical, we got to relax the back, but then we've got it right next to it is a barber shop and a nail salon. And these are the things that I think are recession resistant. Rents typically move up. They have an escalation clause every year. So you're inflation protected. And if you lose one tenant, okay, you lose one, you can replace it. You're not down to zero on your occupancy scale there. So that's been a good move. And, again, going back to the thought of creating value through the NOI, we brought in managers that have increased NOI. We've looked at every line item in the expense ratio, expense budget, and we've been able to improve that. And I think that's a better model for us long term.
Are these single story like strip malls? I'm trying to like kind of visualize this. And how many? What square footage? How many tenants? Give me a little idea of it.
Yeah. So the one in Tucson is, I believe it's 18,000 square feet.
Okay.
And there are 14 different tenants.
And that's all this single story retail.
Yep.
Sure.
Right on a main corner. And again, you've got to be very careful with real estate where you buy. Location is so important. So when we're looking, not only did we love the tenant mix, but we're on a hard corner where there are over 120,000 cars passing by every year.
A lot of traffic.
So for that type of asset, you really need to make sure that tenants are going to want to be there, right? They're going to want to be in that spot because of the high traffic count.
How's the parking situation?
Yeah, good. We share the parking with a Denny's. So, moons over Miami. Sundays, I guess, can get a little crazy. But overall, I think it's 2.5 spots.
Yeah, I was to say, I mean, one thing that I would have never 5 years ago, if you would have told me this, I would have never thought about is just how critically important parking is, especially when you're talking about mixed use or retail, or even like service business or restaurant tenant, any of those. It to me, parking is literally what the hinge that makes or breaks a lot of these deals, because when you try to make a deal work that has less than ideal parking, you always pay for it in a big way. And so it's one of the first things that we evaluate on any potential deal that has a mixed use or, really any deal, but certainly retail.
Yeah. Yep, that's smart.
Okay, so out of all the things you've done and been a part of, like what asset class are you most excited about? Like what do you, when you're looking for deals, evaluating deals, like what gets you excited?
It's still multifamily.
Yeah.
Why is that? Despite having other asset classes that we're comfortable holding, I just see multifamily is continuing to be a great place to invest. Obviously we had a huge run up in supply over the last couple of years. That's dropping off. Um, the United States is becoming more of a renter country,
Mhm.
renter nation. Um, so we still see multifamily in the right location as long as it's quality property. I wouldn't want to be buying B or D, C class right now, but A, B class property. There's a real demand for that.
Yeah.
Continuing to see that where we've invested.
And what markets generally?
Most of our multifamily is in Northwest Alabama.
Okay.
It's about an hour west of Huntsville.
Okay.
It's called the Shoals. It's made up of 4 towns: Florence, Muscle Shoals, Tuscumbia, and Sheffield. And it's a booming area, 2 hours south of Nashville. Um,
And this is a market that you're still active in. You're trying to buy more.
it is. We bought our last 2 deals there. We raised $9 million and bought 2 deals together. We're combined 17. So we're going in over 50% cash down.
Mm.
Got a lot of equity in these deals.
Yeah.
But yeah, I mean, it's a great area. It's growing like crazy. Huntsville's a little bit overproduced in our mind, but these tertiary markets around Huntsville are really great.
Yeah. So looking at the market now, we're in 2025. Obviously, people are seeing these struggles with rising costs, rising expenses. Certainly, multifamily, we've seen a lot of that. Sounds like you've hedged yourself a little bit because you're doing this really low loan to value against these assets you're buying. But where do you see market changing going forward? Like what are you guys looking for when you're evaluating the deals or the economy as a whole where you see potential wins and upside coming?
Well, let me jump back for a second because something you said triggered a thought in my mind. Being cash heavy in these deals not only helps us to cash flow, but it helps us to sustain a very achievable rent structure for our tenants.
Mm.
Right. So there's another community down the road. A lot of money's coming into this area, and we saw another community sell down the road. My guess is they didn't have a lot of cash in the deal. They immediately jacked rents up to a point where we didn't even feel comfortable
Mm.
bring that up
Mm.
to tenants.
Mm.
So the fact that we've got that they're coming in cash heavy, low leverage, allows us to really focus on our tenant base as well, which is really important to us. We don't want to go in and say, "Hey, your rent's going up 50% next year."
Yeah.
So, and then the second part of your question was,
Yeah. So, looking at all the economic factors that we're dealing with today, where are you seeing upside going? Like, do you think there's going to be more inventory coming to market for people to buy? Do you think it's going to be a slowdown in new inventory hitting the market? Like, where do you see upside in multifamily?
yeah, well, certainly the new builds are slowing down, right?
Mm-hmm.
Where rates are, just the supply seems to be shrinking and absorption seems to be happening across different markets.
Mm-hmm.
Um, as far as new deals, like older communities coming on to the market, I thought that was going to happen for the last year and a half, right?
Yeah.
I really thought we'd see a lot of defaults because they've been happening. You've seen so many sponsors who took on bridge debt, got in big trouble, and I thought that would lead to a lot more inventory on the market. And you're seeing some of that, but not as much as I would have thought. So while we're keeping our eyes open for those opportunities, it might not be this cascade of new inventory like we thought there would be.
Yeah.
So we're just looking for good deals. We're looking in the markets that we feel comfortable in, and if we can make the numbers work and have it, fixed debt on the property for a long term hold, that's what we're looking at.
All right, let's do the good deal, bad deal segment. So, do you have whatever you want to go with first, good or bad? Obviously, we're looking for a deal you're really excited about that either went really well or you're in the process of, and obviously, either achieved or overachieved your outcomes you wanted. And then, obviously, on the bad deal, we're looking for one that either didn't go to plan, maybe it lost money, or just had a lot of painful lessons learned.
Um, oh man, I got to be honest. I feel really blessed in my real estate journey. We have not had we haven't stepped on a lot of landmines, and a lot of that is kind of what we've been talking about. It's just low leverage, longer time horizon. I can't tell you. I've lost money on a personal residence in Chicago.
Okay.
I had a flip, or I'm sorry, not a flip. I did one spec home that didn't go the way I thought it did. And I look at all those, and really it came down to time, right? Real estate, if you have enough time, real estate tends to work out.
Mm-hmm.
If you're not constrained by your debt when it comes to timing, if you're not constrained by a move, like for example, we were moving to Charleston. I had to sell my house.
Right.
I didn't have time to wait it out. So we lost money. The spec house that we built, and I'll never do that again. But, I don't know what I was thinking, but it sounded fun. So we did the spec house, and the market softened during the building process.
Mm.
And we listed it, and we could not get anywhere close to where we were hoping we would be selling for.
Yeah.
But again, we had time on our side. We were able to rent that property for 5 years, and then eventually the market came back a little bit, and we were able to sell and do just fine. I will say, for anyone looking to buy, this probably across all asset classes, but multifamily, the 20 unit we bought in 2018 was a C to D class property. And we've done a great job managing it. We've gotten rents. Rents are 2 times where they were in 2018. But oh my goodness, the capital expenditures on a D class property, they just keep coming up.
Yeah.
They just, whether it's tenant induced or just wear and tear. I mean, last month we had a fire. A tenant was cooking, and for those listening, I'm putting this in quotes. The tenant fell asleep while cooking.
Mm-hmm.
So, for me, I look at that. I'm like, I'm not sure I would be looking at C or D class properties just because they seem to always have issues.
Yeah.
I don't know if you've experienced that.
Yeah, absolutely. Yeah. I have a 40 unit right now in kind of a D, C minus type of neighborhood. It's a 1950s built, 3 buildings. And I was just talking to a broker friend of mine the other day. I'm like, this thing is less than a third of probably a quarter of my portfolio, and it's 75% of my time, just dealing with headaches, dealing with, crappy tenants, dealing with the management. So yeah, I mean, I'm motivated at this point to try to sell it. It was a great deal. We're going to make good money on it, but yeah, just to get the burden and get it off my bandwidth, because it's such a, life sucking type of asset.
Yeah.
I'm looking forward to selling that one.
Yeah. And it's where you're at when you're buying, right? For us at the time, that was what we could afford. And it was a great deal. Like you said, we'll do really well on it. But the heartache, the headaches that it's caused, that would be, I guess, not a bad deal financially, but a bad deal when it comes to, keeping me awake a little bit at night. So,
yeah, I mean, I think as I've matured as a person and an investor, and, as you mentioned, your life circumstances change, things that were motivating to me 5-10 years ago, obviously the motivations change. It's all part of the journey and figuring it out. But yeah, I'm definitely at a place now in my life where I'm looking for the types of deals that I'm going to, one, be passionate about, because at a certain point, it's no longer really about the money. The money's not the primary motivation. So things that I'm passionate about, I'm actually doing something that I want to see happen in the communities I'm investing in. And so it's like some of that kind of personal fulfillment more than the financial fulfillment. But 2, I want to invest in things that are going to make my life better as a whole and not worse, and some of that's, whether that's time, that's effort, that's energy, that's, peace of mind, things you're talking about, being able to sleep at night and not worrying about what kind of phone calls you're going to wake up to and the problems you're going to deal with tomorrow. I don't want to sit here and give the wrong impression that just investing in, high C or B or A class investments is going to just all of a sudden give you all this peace of mind. I mean, there's problems at every level, but generally speaking, when you're dealing with a higher income tenant in a better neighborhood, those problems are less likely to occur. So we're talking in broad generalities here, but there's definitely when you self-manage or have vertically integrated company like I do, and I'm a part of every aspect of this process. Changing up and trading up into better quality assets and better locations, it certainly buys back a lot of your time.
That's right. Yep, absolutely. So I resonate with that. Again, you get to a certain point in your investing journey, your career, where peace of mind is worth more than squeezing an extra dollar
and
out
your
of a
time,
property.
And
your time.
Yeah.
And
I mean, times, obviously this is cliche, everybody says it, but time is your most finite resource. But I have 3 kids now, and the time I can set aside for the family and the kids is relatively priceless. And when you're managing a bunch of D-class assets, that takes a lot of your time and mental capacity.
Yeah. How old are your kids?
My youngest, she will be 2 in August. My son's 3, and my oldest daughter she'll be 8 in July. So
Okay.
1 to 8 or 1 to 7.
That's fun, man. It's fun. Got my oldest is about to graduate, or I should say, move from her freshman year to her sophomore year. So she's driving. It's like,
nice.
It's just amazing how fast it goes. And
yeah,
when we started Missional, all of us are fairly far along in our careers. We've all got, a fairly extensive real estate journey. And to your point, wanting to see, what's cool about you on the development side, you literally can build what you want to see in your community. That's not my skill set. But for us, there was this element of, we really want to create a company that's focused on giving back. And that's in the name Missional. And we do that through our service to our tenants. We do that through giving quite a bit away out of our acquisition fee. Every investor we have gets to pick a like-minded ministry or charity. So, and that's just so fulfilling to us, So, I think there's this evolution. There's this natural evolution of your real estate journey, and you're probably going to start with a C-class, D-class property at some point along the way, and eventually move out of that, do what you want to do. So.
Yeah, and that's great, and I love one thing. I've said it many times on this show and other shows I've been on, but it's like the average person in real estate, from and I know nationally and internationally, landlords get a lot of bad rap, and there's a lot of crappy landlords out there. I get that. I do understand why the public at large oftentimes has a negative view of landlords, but I will say that at least my perspective and my circle and my network and people that I choose to hang around and learn from and be friends with are more often than not very giving people. They're kind. They want to see things that they touch and are a part of be better for everybody, obviously for themselves, for their investors, for their families, but certainly for the tenants, for the community that they're investing in, whatever asset class it may be. And honestly, having worked in some other industries, I was in law enforcement, and I worked some retail and other like jobs when I was younger. That was not really a common thing. Really real estate was the first time I was surrounded by, more often than not, those people that are, I don't want to say selfless, but have a lot of selfless tendencies in their character. And I think it's great, and I love being a part of that community and helping foster it.
Yeah, I agree with you. And real estate tends to set you on a trajectory where you're able to do some of those things.
Right.
We did a really cool thing. We were able to go down right before Thanksgiving of last year, and we went into one of our communities and we brought barbecue food trucks out, gave away pies, and man, we received it was so cool. But that's not a pat on our back. It was not a big thing, right? It was not, but to our tenants, it meant so much because they appreciate that someone looks at them with value and says, "We're thankful for you." So anyway, not to get off on that tangent, but if you can treat your tenants with respect and do what's right for them, that's going to benefit you long term.
No, absolutely. And, I'm happy to talk about it because I've told this story, but for anyone who hasn't heard it, we've done some renovations on properties where, my background was a lot of heavy value add real estate, where tenants will come to their move-in day and we've literally had tenants crying, sobbing, just because they're coming, maybe even in the same neighborhood. Like some of this was like student rentals, right? Where they're literally maybe moving a block up the street to a new house for the next school year, but they're going from a roach infested, rat infested, literally, where it's just slumlord, doesn't do maintenance, doesn't fix anything, doesn't care about his tenants, just to go to a place, as you said, where they feel valued, they feel important, where it's not just this transactional, you get to stay in these four walls and you pay me money and don't call me for anything after that. To have that level of care, to show the tenants that you actually care about, where they're going to live, as much or more than they do, hopefully, as much or more than they do. I think that's the human element that gets lost in real estate a lot, that this is more than just brick and mortar and spreadsheets and things like that.
Yeah, that's awesome. Very cool.
Okay, so before we run out of time here, let's talk about a deal that you were really excited about or one that went really well. Do you have one in mind for that?
Sure. Yeah, I can share one that went really well. It's great when cap rates work in your favor. We did and again, I'm trying to take some of that nuance or that variability out of our investing, but sometimes it works in your favor. The Tempe Walgreens that I mentioned earlier, that was one of our properties, and we 1031'd into that, bought it in 2020, bought it in a 6.5 cap, and put a little bit of debt on it, not much. Cap rates compressed, down to 4.5 when we sold it.
Wow.
2 years. 2 years was a completely different price point. And I won't get into the numbers too much, but a completely different price point.
Sure. I can imagine.
Yeah. And it was real money. And we didn't do anything. It was a triple net property. Walgreens paid us rent the entire time we owned it. And that worked out well. The properties that we've done recently, the 2 apartment complexes in Alabama, we've had a lot of success there. We've only owned them we owned the timbers for about a year now. In Summerfield, it's been about 4 to 5 months. Been really excited about the way the market has reacted. We knew we were buying at a low price point when it came to rent. I mean, rents, when we bought these, the average rent in the community was around $900.
Wow.
And great community. We knew that was artificially low. We saw what other places were renting for. So we knew we had an opportunity right off the bat to move rents up. And we were careful in the way we did that with current tenants, but any turnover we had, we were able to achieve significantly higher rent than that. So, those are the 2 that come to mind. So one was simply getting lucky with market timing. The others, just identifying a deficiency in the market and believing in your thesis and being able to go and execute on that thesis. So,
yeah, I actually just had another conversation with Nick Stageberg, and I'll give him a quick shout out because he kind of explained something to me, and I never really thought about this way. But their philosophy when they go into these unit turnovers, as you mentioned, right, existing tenants and inherited tenants, they have this kind of like entry interview with every tenant when they buy a property, and they're like, "Hey, what do you want to see happen the next 1 to 3 years, or 1 to 5 years, whatever it may be?" And if they want to stay, they have this really cool way of where they kind of build out a custom plan for each tenant in place. Like, hey, your rent is going to go up slowly, but if you want to stay, we want to work with you and your budget constraints to make that happen. And there may be a case by case basis where maybe it is an elderly tenant on a fixed income, and they're very cautious about how they work with them to try to get their rent up but affordable, which allows them to then really game plan on what units are turning and how. But it was just a really cool way to systematize the business strategy of how they turn an individual property. And it was something I'd never really thought of it in that kind of nuanced way. But
that's really neat because I will tell you when you're taking over these communities, there is some trepidation from the current tenants. They're like, I know my rent's going to go up.
Yeah.
How much is it going to go up? So
yeah, they've all been through it. If they're tenants, they've been through this.
Yeah. So I don't know Nick, but maybe I'll have to connect with him and
check that. I mean, literally we just recorded, so I don't know when that one will go live. But he was a wealth of knowledge. You should check it out. I want to re-listen. Cool. That's one of those where I want to go back and re-listen to it. When it comes out. But cool. That's one of my favorite things about being having this opportunity as a best ever podcast host is I try to selfishly learn as much as I possibly can, and I try to ask the questions I want to know, and hopefully our listeners learn as much as I do.
Yeah, that's great.
Well, all right. Well, we are running up on time here. Any other final thoughts you want to leave us with today before my last question?
No, if you're interested in what we're doing, you're probably going to ask that.
That was my next question. Go ahead.
I'll jump the gun.
How can our best ever listeners connect with you?
Yeah, you can always go to our website, which is just missional.group.
Okay.
And then really for real estate or financial planning, whatever it may be, find me on LinkedIn. That's typically better unless you want to see a bunch of kids' photos on Instagram or something like that. So
Gotcha.
LinkedIn's typically best for me. So.
Well, Troy, we can link to that in our show notes. I appreciate you giving us your background and all your experiences and the lessons learned from them.
Joe, thank you so much. It was great to meet you.
You as well. Best ever listeners, thank you so much for tuning in. If you enjoyed today's episode, be sure to leave us a 5-star review and share this with someone who could value from it. Make sure you're following and subscribe to the podcast so you don't miss any. Thank you for listening. Have a best ever day.